Hello, it's Patrick Battalato. I wanted to spend a little bit of time talking about the balance sheet, and we might as well get right into it on this one. So, what we have here is I'm going to cover two balance sheets actually, one from PepsiCo and another from Chipotle. Those are two companies I'm hoping you're familiar with, a major distributor of soft drinks and a variety of snacks in PepsiCo, and then a company making their version of Mexican food, as they say, with burritos and other things across a variety of restaurants, quite a few restaurants in Chipotle, in the fast casual quick service space. So a restaurant and actually Pepsi is a supplier to restaurants, although it does not directly supply Chipotle stuff. I think their stuff all comes from Coca-Cola, but it still works in the same regard. Let's go through their balance sheet of Pepsi. I'm actually going to cover assets first. And as you see here on the slide, I have broken up their balance sheet into the asset half. And then I'm going to cover liabilities and equity. The whole balance sheet actually needs all of them, but just for the purposes of having this on a slide, it's easier to just put the assets on and then do the other one. So my goal here is just to talk generally about what we see. I'm not in any way assessing good or bad, just a description of what's there and what does it mean. Not an analysis of a company, more along the lines of what kind of assets do they have? What does it mean when we see these terms? So very descriptive in terms of what's happening here. So companies report their assets. As you can see, at the bottom of here is the total assets, and then line by line of the variety of assets that they have. It's worth noting that the balance sheet is at a moment in time. So that's really saying here that on December 31st, 2022, these are the assets that they had. Also, December 25th, 2021. So depending on the specific date given, and the company must provide the date, that means the assets as of that date. This is a comparative balance sheet, meaning that there's at least 2 years. Companies are required to do 2 years. They actually could do more than two, but we have 2 years here to work with. Fiscal year ending in 2022 and fiscal year ending in 2021. So let's go through these. The balance sheet on the asset side is split into current assets and non-current assets. They don't always label them as current assets or non-current assets, but you can kind of tell that the current assets, because there's they say it a little differently here, but they say assets, current. And for most of these, what I did is I just stuck with what they gave me. I made only minor modifications to take out some extra terms, but I'm using the information that companies are providing on their financial statements in their annual report. So we have, in this case, assets, current, but that just means the current asset. So what is a current asset? I'll describe the general category and then we'll show the specifics. It's an asset that the company expects to receive the benefit from within 1 year or one operating cycle from the balance sheet date. So it's like an asset they expect to benefit from before technically the end of December 31st, 2023. Doesn't mean they must, just that that's the expectation. So the balance sheet is organized in terms of liquidity. Current assets, they should get the benefit from them. And the benefit is commonly, but not always, cash within 1 year. All right. So cash and cash equivalents. Well, it already is kind of liquid available cash. Cash equivalents are just not like literal cash, the green dollars and bills, et cetera, but things that are so liquid for the company that they could use that money to buy things near immediately. Short-term investments are not that. These could be things that we ourselves have as well. And companies can have just additional money they have and they want to put away somewhere and get kind of a return. So for example, if Chipotle had a CD, a 9-month CD or a 6-month CD, and actually many individuals may have that given prevailing rates at the time I'm recording this, they would put that in something like short-term investments. It's not exactly cash and it's not perfectly liquid, but it's still liquid enough. And then they have accounts receivable. Accounts receivable is an important accounting term. It represents that revenue that Pepsi, I think I said Chipotle there, I'm talking about Pepsi here, I apologize, it would still be the same thing. Revenue that Pepsi has earned, but they have not yet collected from their customers. And this is a really good example why it's actually a large one for Pepsi, and that makes sense. But this is a good insight in think about who the business is before you start examining the financial statements. That should help out a lot. Who is Pepsi selling to? Well, they are selling to convenience stores and some restaurants and some grocery stores, places like that. And because those are all large enough businesses with recurring business with PepsiCo, it is likely, in this case, it is certain that Pepsi sells to them on account. What does that mean? Pepsi provides the goods or services, that's drinks and snacks and stuff, before it collects the cash from the customers. So it could be selling this to a Kroger, the grocery store, and Kroger will pay Pepsi back in 30 days or 45 days or something like that. So accounts receivable represents prior sales that Pepsi had that were recorded as revenue that it has not yet collected the cash from. So that's the expected cash inflows. The expected accounts receivable is the expected future cash inflows from prior sales on account, right? Inventories. Well, this would be the products that Pepsi is selling. So this would be its drinks and snacks and other items. That's the amount that they still own. They haven't yet sold to anyone, but they plan to sell, likely very quickly or very soon. I'm sure they don't try to hold on to the stuff for too long. So just to put these in dollar amounts, these are reported in millions, meaning that they have almost 5 billion in cash, a little over 10 billion in accounts receivable, and a little over 5 billion in inventory. Prepaid expenses and other current assets, that's a good example of a account that just includes many smaller things. So if they had prepaid rent or prepaid insurance or other things like that, that would certainly be reported there. The argument being made here is that the items inside aren't big enough to be disaggregated or separately listed. Companies commonly will do some degree of aggregation and just put a bunch of small things together. And that usually goes into an account that's labeled with something along the lines of other. So like other current assets in this case. Right? Put all those together. Sorry, then they have the disposal group, including discontinued operations, assets. That's a mouthful. And it's just basically that they have some operations they've discontinued, they're no longer doing, and they're going to have both an asset associated with that in 2021 and actually liabilities as well. But they're like, these are things you can think are like moving their way out of Pepsi. They were a part of their operations, but they're not going to be in the future. And we actually see that because it's on there on the balance sheet, the 1.7 billion in 2021. But by 2022, that amount goes to zero. Companies still leave the line item there even if it's not even if it does not have a dollar amount in both years. But it reflects that it was like something on the way out in 2021, and it was actually completely out by the end of their fiscal year 2022. So technically, we know that during fiscal year 2022, they fully got rid of those, as it looks like they were intending to do anyway. All right, add all those together, you get the current asset amount. So that's the current assets. They have roughly $21 billion in both 2021 and 2022. Then what do we get into? We get into our non-current assets, not always labeled, but understood. What do these mean? Well, they're less liquid because the company expects to have them or benefit from them for greater than or beyond 1 year. So whether it's like 20 years or even 2 years, you would list that as a non-current asset. Property, plant, and equipment, net. That's all of their production facilities, supply chain stuff, trucks, those sort of items. The larger tangible items of property related to running their core business over time. And these are surely assets that they have in place and plan to have for many years. So they're going to be listed as non-current. That's a relatively large amount at $24 billion. Amortized intangible assets, net. Actually, I should cover that word net. Net for the property, plant, and equipment means net of depreciation expense or accumulated depreciation expense. So that's not the amount they paid. It's like an estimate of the value of those assets today. And the difference between what they paid and the estimate of that value is like an estimate of how much has been used up. So depreciation expense is a way of reflecting just the, wear and tear. And as you use things as you drive trucks, as you operate a factory, those assets lose their value over time. So the net is that item is kind of not its original cost, it's net of accumulated depreciation, the total depreciation those assets had to date. Same thing with intangible assets, except the difference is that property, plant, equipment is tangible. We can touch it. Intangible assets are not that. These are patents, trademarks, trade secrets, etc. And in this case, if they're being amortizable, that's what it says. That means they have like a set useful life. So, they have certain useful lives that Pepsi has estimated. The detail of all the stuff would be provided in the footnotes, but I don't want to go into the footnotes in this particular lesson yet, but we will. That's just assets that they have. They're not we can't physically touch them, but they still create value for Pepsi, but not indefinitely or not forever. So they're going to amortize them. Amortizing is basically a way of saying that, look, the value will go down over time, and we're reflecting that economic reality. So the value of these is going to go down kind of, if you, best way to think about it is like as each year passes. So you have a trademark, a trade secret, a patent. It has value, but the value doesn't last forever. Goodwill. Goodwill is a unique and actually somewhat challenging term in accounting. Unfortunately, I want to apologize on behalf of accountants for this one, as I usually do when I teach these classes. It's not likely what you think it means, and you're not wrong. I just think we chose a word that already was in, the vernacular, already a part of conversations, and we don't exactly mean that. So goodwill doesn't mean the general sense of the word goodwill, what people feel or think about your company, whatever else. It unfortunately has a specific definition in accounting, and I'm just going to have to give it here. It's the premium a company has paid in a prior acquisition when they bought something but paid more than the net asset value. So when you buy a company and you pay more than its net asset value, real quick, not a deep dive. If you spend $100 on a company, and I'm making up numbers here, of course, and the company's net asset value is $80, then you would be recording $20 of goodwill. So not a deep dive into goodwill at this moment. We can do that in one of the more advanced topics, but it's a premium the company has paid. So this is where I just want to get this point across right now. If you see goodwill in a balance sheet, it does tell us two things. One, the company has had acquisitions. You can only have goodwill if you have an acquisition. And two, in those acquisitions, it paid a premium, right? We're not debating good or bad or any of that stuff right now. I'm just stating things the way they are. This is not a commentary on should they have done it or should not. Did they overpay? We're leaving that out. But we do know with certainty that Pepsi has had acquisitions in the past and had paid a premium in those acquisitions. Now, it could be one or more than one. The footnotes and the other descriptions would tell us that we can't actually determine exactly how many just based on the balance sheet alone. All right, that's my coverage there. Let's keep going. The next line, indefinite lived intangible assets. These are ones where it actually would be more like the trade secret in this case would be here, which is an item that doesn't have a definite life. Like it's not set to last for 10 years or 20 years. It's argued to last forever. It doesn't mean it literally lasts forever. It's just that we don't have a way of saying it has exactly this particular life. The difference with that one, and you can actually see this here, there's no like common net. If the thing has an indefinite life, which is really not possible with physical property, I guess you could say land is that, but then we would not amortize it. So it just holds its value. Now we have additional methods in accounting to deal with this. If the value has gone down, it's called impairments, not the scope of today's topic, but just so you know, if there's hey, what about this? We almost always have an accounting solution for, any complexity or any change in business transactions. But I just want to note that they have physical property, plant, and equipment. They have intangible assets that have definite lives, meaning like 10 years or 20 years. And then they have indefinite lived ones, which means they can last forever. They've also had goodwill where they acquired another company and paid a premium. Next one, equity method investments. That's just a investment in other companies. The equity method we'll cover later, but that just means it's like a meaningful investment in another company. So without getting too much into that, it's like that Pepsi didn't just do like a small little investment like you or I might make. It would be more of a meaningful investment. They didn't acquire the company, but they made a meaningful investment in the company, gives rise to what's called equity method investments. Deferred income tax assets. Another deep dive, great conversation on this one. I love talking about taxes because it really shows how the stuff works together. But the basic idea is if you have a deferred tax asset, that's the right or the opportunity to pay less taxes in the future. The specifics well beyond the scope of this, but if it's an asset, it has to be creating a future benefit for the company. And so this means that as of 2022, there's unique situations that allow Pepsi to pay less in taxes going forward. Other assets, well, these are other non-current assets. So it's the collection of other stuff, much like we saw with the other current assets, but these are just ones that Pepsi expects to last beyond 1 year. All right, then the total assets, just adding them all up. So we have all our pieces. I covered all the pieces on Pepsi's asset side. Let's get into their other side, still Pepsi, but now the liabilities and equity. All right, on the liability and equity side, the assets are the items that we expect future benefits from, that we have, we have the rights to those future benefits and we have the ability to recognize these. Liabilities are the items that we expect there to be a sacrifice for. So we have to pay, we have to settle, we have to make good on. And those are reported as liabilities. Let's get into them. Short-term debt obligations. The first one they have at $3 billion. Well, that's debt and it's short-term. The liability side of the balance sheet is actually organized in a similar way to the asset side, except it's when it comes due would be the current ones. So current liabilities are going to come due within 1 year of the balance sheet date, and non-current are going to become due. We're going to have to settle them beyond 1 year. So short-term debt obligations is listed first. These are debt obligations that PepsiCo has, and it's going to have to make good on. If they're listed first there, it's likely within a month or so, or slightly around that. All right, that's amounts of debt they borrowed, the principal amounts they borrowed, they have not yet paid off, and they're expected to pay off in the near foreseeable future. Accounts payable and other current liabilities. Accounts payable are items that amounts they owe to suppliers for usually goods or other things they've received. So if they buy a bunch of sugar or forms of sweeteners or grains or whatever else from a food company or a farmer, then they would actually be, if Pepsi's buying from them on account, which is realistic, Pepsi would have an obligation to pay that supplier for those ingredients in the future. Commonly, accounts payable would be representing this, and these are due within like 30 or 60 days. So accounts payable is a future cash outflow, an expectation of it's the amount that Pepsi is going to have to spend in cash, pay to its suppliers in the future. Disposal group, we saw that on the asset side. Just to complete that story, that's just the liabilities associated with that. There was something they were disposing of in 2020, planning to dispose of, and they did dispose of it. And that actually meant that they disposed of both the assets and the liabilities. The footnotes would give us more information, but not a deep dive in the footnotes at this moment. Long-term debt obligations. It's the same thing as short-term debt obligations, except a longer horizon in this case, because it's outside of the current liabilities. It's going to be beyond 1 year. Now, if you've ever had like a mortgage, you could think about like the short-term debt obligations being the amount of principal you owe within the next year in some ways. And then the long-term would be what's owed beyond that, like in the remaining years after 1 year. Deferred income tax liabilities, net. We saw they had deferred tax assets. And these are separately reported for a variety of reasons, but deferred income tax liabilities implies that Pepsi has an obligation to pay in the future, not right now, to pay taxes of roughly $4 billion. So a deferred tax asset is a benefit, the opportunity to pay less given certain situations, and a deferred tax deferred tax liability is an obligation to pay that amount in the future. And then they have other liabilities, non-current. That would just be a collection of the other liabilities they have. Details would be provided in the footnotes. But the argument is that each individual item is not big enough to report on its own. All right. On the equity side, so if assets are what we have present, future benefits from, we can recognize them. If liabilities are what we owe, we have expectation of sacrifice and the ability to recognize them. Equity is what we own. So we here being our shareholders, and let's go through this. Some of the stuff on equity I want to de-emphasize. There can be different categories of equity. It's not super valuable, but let's just go through it. Like common stock and additional paid-in capital, common stock. I would really recommend just combining those. That's the total cash that Pepsi's investors have put into Pepsi at some point in time. It's not the value of Pepsi. It's not the market capitalization of Pepsi stock. It's simply like the total cash that's gone into their business that they've raised in the past from shareholders. Retained earnings is worth noting here. This is the total earnings they've made each year that they've not yet distributed back to investors via things like dividends or repurchases of shares. So they are earnings that are retained in the company. has at that point then earned more than $67 billion. It's simply that that's what it's earned and not distributed. All right. Accumulated other comprehensive income or loss. This is beyond the scope of what we're doing right now. I'll just offer this simply as it's an account that represents a unique set of particular gains and losses that affect assets and liabilities, and just needs to represent that other things have changed on the balance sheet. More of a deeper dive later, but I would say we can kind of set that aside for a second here. Repurchase common shares and treasury stock. The repurchase common stock in shares. It's actually a shares amount. It's not going to have a dollar amount. It's not going to change anything here. Treasury stock, that's the amount that they have actually bought back with the intent of reissuing. These different forms of equity are not super important. If you're doing regulatory filing requirements, everything else, these matter. But for the outsider looking at a company, in many ways, the particular areas here don't matter, with one big difference here, which is I would definitely have a general understanding of the total equity of the company. Some of the which accounts it falls into is really less important. I spent more time on the assets and liabilities for a reason, but at the same time, I want to just be aware of what's their equity. So at this moment in time, their equity is across a variety of accounts. There's a little bit of non-controlling interest, which we'll talk about in a future topic, but in general, they have $17 billion of equity. They have 75-ish billion dollars of liabilities, and they have $92 billion of assets. So some of their assets are owned by the shareholders, right? 72 over 92. And some of the assets are basically not owned by the liability holders, but like there's on the other side, the liability holders have a claim to what Pepsi has on its balance sheet. So they have assets. We went through line by line. Liabilities, I would strongly recommend spending our time there. And there's also resulting equity. The importance of equity is the total amount. Some of the line items on their own, a little bit less important. All right, that's Pepsi. I still want to cover Chipotle, but let's wrap this up for now and just jump back into Chipotle very quickly. Before I do that, just to mention the following, there should be some overlap between Pepsi and Chipotle. There have some shared aspects of their companies, but just so we're on the, have a guideline before we begin, we shouldn't expect that their financial statements, particularly the balance sheet, would be exactly the same. Different companies should have different line items, should have different amounts, should have different aspects. The general idea of assets, liabilities, and equity would be the same, but the specifics would differ as long as the company differed. One more down, 10,000 more to go. I'll be jumping back into this soon.